A 47-year-old database company just made the biggest bet in its history, and it put its own balance sheet on the table. Oracle borrowed over $100 billion to build a new empire of AI data centers. Largely, it turns out, for a single customer. In just 2 years, Oracle's free cash flow swung from positive $12 billion to negative $25, a $36 billion reversal. The company is, right now, a cash bonfire. Why would a profitable giant do this? Because the AI boom needs somewhere to live, and Oracle decided to become its landlord. The prize, a backlog of contracted future revenue worth $553 billion, up 300% in a year, roughly 8 times everything Oracle sells annually. So we rebuilt the methods of 5 of the greatest investors who ever lived and put Oracle on trial, including, fittingly, the Oracle of Omaha himself. But first we do what they would do, we open the books. None of this is financial advice, it is how the great minds actually think. For 47 years, Oracle sold databases, the boring, mission-critical software that runs banks, governments, and airlines, a fortress business, with switching costs so high it raises prices 10% a year and barely loses a customer. Then it bet everything on a second act, OCI, Oracle Cloud Infrastructure, renting raw computing power to the companies building artificial intelligence. And it worked spectacularly. AI infrastructure revenue grew 243% in a year. OpenAI, xAI, NVIDIA, Meta, all training their models on Oracle. And Oracle plays it clever. It undercuts Amazon and Microsoft on price and weaves its database right into their clouds too. Its moat travels with the customer. And the old moat is deeper than ever. Oracle raises its database prices about 10% a year and barely loses a customer. Its multi-cloud revenue grew over 1,500%. That lock-in is the one thing here nobody disputes. And why did the AI labs pick Oracle at all? Cost. Its top chips run nearly 60% cheaper than Amazon's or Microsoft's with 4 times the networking. For a training run worth billions, that edge is decisive. So is this a brilliant reinvention, or a 47-year-old company gambling its balance sheet on a boom that might not last? Don't guess. Run the numbers. Here is how an analyst actually reads a bet like this, the numbers one by one. Start with the backlog, $553 billion of signed, contracted future revenue. This is the number that holds the entire bull case together. If it converts to cash, the debt was genius, not reckless. But here is what the bulls do not lead with. Analysts estimate that OpenAI alone is somewhere between 58 and 80% of that backlog. Oracle did not just make a bet on AI, it bet its balance sheet on one customer. Think about what that means. If OpenAI stumbles or simply builds its own chips, Oracle has constructed a $100 billion empire of data centers with no one to rent them. And the cost of building it is staggering. Free cash flow is negative $25 billion because capital spending now eats 3/4 of every dollar of revenue. Oracle is burning cash faster than almost any company its size. To fund the fire, Oracle borrowed $134 billion at a credit rating just 2 notches above junk. Microsoft and Amazon are doing the very same AI build-out with almost no debt. Oracle does not have their scale, so it borrows. Watch the margins. They have fallen from over 80% to 65% because renting servers is a far worse business than selling software. Oracle is trading rich economics for merely big ones. Return on invested capital is around 10% against a cost of capital near 13%. Translated, right now at the bottom of this build, Oracle is destroying value on every new dollar it deploys. The whole bet is that this flips by 2028. And it is not even cheap, 37 times earnings. A richer enterprise multiple than Microsoft for a business with more debt and worse margins. Line it up against the giants doing the same thing. Microsoft and Amazon, faster or equal cloud growth, fortress balance sheets, positive cash flow. Oracle, the highest multiple, the most debt, and the only one bleeding cash. And one number captures the whole transformation. The cash Oracle returned to shareholders versus what it spent on capex collapsed from 4.5 to 1/10. The most aggressive buyback machine in software history just stopped to pour everything into GPS. The bulls have a real counter. Many of these AI contracts are prepaid or run on the customer's own chips. So Oracle may not be funding the whole build alone. The leverage is frightening, they argue, but it is partly hedged. So the whole question is timing. Does $553 billion of backlog turn into real cash before the debt and the bleeding become a problem? Let the legends decide. Philip Fisher, the father of growth investing. He hunted companies riding a genuine, multi-year wave of demand, and he was willing to look past a scary price if the runway was real.
Fisher's model is impressed. This is a real technology wave, not a fad, and Oracle has a structural cost and performance edge that the biggest AI labs are voting for with their wallets. And Fisher would note Oracle isn't renting bare metal. It bundles its database and software on top, which makes the customer far stickier than a raw cloud rental. To him, that is a real runway, not a commodity. A backlog 8 times revenue is exactly the long runway he searched for his whole life. His one worry is the concentration. But on the growth, he is a believer. He scores it a 7.
A 7, but the next voice is the man Oracle is named after in spirit, the one who built a fortune by never doing what Oracle just did. Warren Buffett, the greatest investor of the modern era. He prizes 2 things above all, a durable moat and real owner earnings, and he avoids one thing above all, debt.
Buffett's model respects the old Oracle deeply. The database fortress is a genuine wide moat, but he looks at the new Oracle and sees everything he spent 70 years avoiding. And he would say it calmly. He sat out the entire dot-com boom and looked like a relic for 2 years. Then it collapsed. He is perfectly comfortable missing a party that ends in a pile of debt. Owner earnings, the real cash a business throws off, have gone deeply negative, and it is funded by a mountain of debt bet on a single customer. To Buffett, a wonderful castle is worthless if you mortgage it to defend one gate. Leverage, he warns, is how smart people go broke. He scores it a 2.
A 2 from the Oracle of Omaha on Oracle itself, a 7 and a 2. Then comes the man who actually loves a big, leveraged macro bet. Stanley Druckenmiller, decades without a losing year. He follows the biggest macro wave he can find, and he is not afraid of leverage when the trend is his friend.
Druckenmiller's model likes this. The single biggest capital wave on Earth right now is AI infrastructure, and Oracle is one of the purest, most leveraged ways to ride it. His real edge was never picking, it was sizing. He would own Oracle, but small enough to sleep, and he would be the first one out the door the moment that backlog so much as wobbles. He would own it while the liquidity flows and the demand accelerates, but his discipline is the exit. The stock already derated 20% and a single customer is the whole thesis. He rides it with his hand on the door. He scores it a 6.
6, the momentum bull is in but nervous. Then comes the man who calls a moat a moat. Charlie Munger, Warren Buffett's partner for over 4 decades, avoids stupidity, invert the problem, and never confuse a great business with a great gamble.
Munger's model would invert it. Do not ask how Oracle wins, ask how it loses. And the answer is glaring. It loses if one customer walks, if AI demand pauses, or if the debt reprices. 3 ways to lose all at once. He would quote his own partner, "There are no called strikes in investing. You are never forced to swing. And a leveraged bet on a single customer is the easiest pitch in the world to simply let go by." The database moat is real, he would grant, but renting commodity computing power on borrowed money to a single tenant is not a moat. It is a bet. It clears his quality bar and fails his risk bar. He scores it a 3.
A 3, 4 legends in, and the board is deeply split. One voice left, and he studies exactly this kind of leveraged bet. Howard Marks, the master of risk and cycles. His genius is second-level thinking, asking not just is this good, but what is already priced in and what could go wrong.
Marx's model sees the defining tension of this whole AI cycle in one stock. A magnificent opportunity, financed in the most fragile possible way, at a price that assumes it all works. And he would point out the cruel irony. The better the AI boom gets, the more Oracle borrows and builds, and the harder it falls if that boom merely pauses. Success itself becomes the risk. His question is always the same. Where is the margin for error? Here, between the negative cash flow, the debt, and the one customer, there is almost none. It is not distress, he would say. It is a timing bet dressed as an investment. He scores it a 4.
A 4, so the playbook closes. What does the board decide? 5 legends, 1 company. Fisher 7, Druckenmiller 6, Marx 4, Munger 3, Buffett 2. The combined great score for Oracle, 4.4 out of 10. And notice the split. The growth investors see the wave, the value investors see the debt. The same company judged a 7 and a 2, depending on which risk you fear most. Here is where they agree. The AI demand is real. The old database moat is real. And the way Oracle financed this bet with borrowed money and one giant customer is genuinely fragile. And here is the fault line. Fisher and Druckenmiller say ride the biggest wave of your lifetime. Buffett and Munger say no wave is worth betting the company on debt and one customer. Marx just asks you to respect how little room there is for error. A 4.4 is the board saying this. The prize is enormous and so is the risk. Oracle is not a bad company. It is a great company making a bet that will either look like genius or like the moment it overreached. And the next clue lands fast. Oracle reports earnings on June 10th. Watch 3 things. Is the backlog converting to cash? How dependent is it on OpenAI? And is the cash bleed getting better or worse? So what is your score for Oracle, genius or overreach? And which company should the board judge next? Tell me below. This was the Greats Playbook, where history's greatest minds judge the companies of today. None of this is financial advice. These are AI models of public investment methods, not the investors themselves. Study the greats, then think for yourself.